Hello, good morning and welcome to ET Now's Buy Now, Sell Now with me, Varun Hirimat, and along with me, Babina Kapasi. With that being said, let's get a move on and take a look at what we have lined up for you as far as headlines are concerned. It seems that despite some headwind that we're seeing in the markets for a change, we are at the day's high. Auto and metal stocks are driving the Nifty Upmove currently as we speak, and the Bank of America Fund Managers Survey indicates that a new bull run has begun. Let's hope it's true. Moving forward, we have M&M in top gear this morning and definitely in focus. The company may divest controlling stake in Ssangyong. This is a report-based story right now, so don't take it for face value, but nonetheless, it seems that it could be very much on the anvil. The next one is LVB, and this one's coming back after a while, after a little hiatus, I would say. Proposed amalgamation with Clicks Capital in last stage. So this is something we heard about a couple months ago, that Clicks was evaluating LVB post India Bulls possibly not being the preferred candidate. It now seems that both parties have done their respective due diligence. Final conclusions are about to be reached on that deal as well. So keep an eye out for that counter. Very interesting. The next one this morning we have is a Hexaware, also making news. It's received cumulative bids for around 86.6 million shares at 475 rupees per share, which is definitely a premium to 450. The current CMP is 450, which represents 29% of shares of Hexaware being put out on offer, higher than the minimum threshold of 27.66% required by the promoter to be able to go ahead with the delisting process. The process has also been extended by a day. So that's got Hexaware in focus. We then have Vedanta, which has won a case over $499 million of cost recovery from the Indian government. So that's got that counter in focus. And then finally, in just terms of managing the crisis and global cues that we're going to be keeping an eye out for our markets, all eyes are going to be on the Fed meet, which will be underway over the next 2 days. And then we also have the Bank of Japan, which is the second largest stimulus printer in the world. And then the Bank of England, all meeting in the following week. So key commentary expected from central banks. Over to you, Mubina.
All right, thanks Varun for that. Well, yes, we'll be tracking all of this and more all day today on ET Now. But let's remind our viewers what we have lined up today on Buy Now, Sell Now over the next course of the 1 hour. Starting off first with our BNSN Explained segment. Many a times people do stay away from investing because of the immense amount of jargons involved, especially when it comes to investing, when it comes to reading an annual report, which is really the basic tenet when you go about to invest. So we will be explaining to you the basics of investing. We will be de-jargoning the whole world of investing on Buy Now Sell Now today at 11:30 a.m. And for all the ardent D-Street trend spotters, it's time for the BNSN quiz as well, where we test your knowledge and your trend spotting abilities on Dalal Street. Every day we ask you a question, and we will be disclosing the answer as well to that question at 11:45 a.m. For those of you who are interested in participating, don't forget to tweet to us. Our Twitter handle is @BuyNowSellNow. So today at 11:45 we will be disclosing the answer as well as our BNSN quiz champions. Well, let's move on and talk about what's up with the equity markets. It's another day of gains being witnessed on Dalal Street, and this is something that's caused us to be perched above the 11,500 mark. The Sensex is gaining around 127 odd points. It's auto all the way today, being led by a Mahindra and Mahindra, which is gaining approximately 5%. Varun just flagged off the news around Ssangyong, which is perhaps keeping Mahindra pretty active in trade. In fact, it's now managed to reach 643 rupees. The other beginners in the auto space are Bajaj Auto, Tata Motors as well, managing to really see a nice amount of buying activity. I guess most of it has started off ever since Mr. N. Chandra spoke about making the company debt-free. And apart from that, we also have a Hindalco gaining a good 2.2% Britannia Industries as well, 1.6% for that behemoth. But on the losing side, it's the banking name. So IndusInd Bank down 1.4%, Axis Bank as well losing roughly about the same amount. So once again, the banking index is just about well, not doing that great, 0.25% lower for the Nifty Bank. So all in all, very tepid moves being witnessed on both the losers and the gaining side. That's with respect to what the equity markets are up to, Varun. And yes, of course, we will be watching out for the Fed meet as well, which is underway. I guess in all probability, once again, we'll be seeing interest rates staying at that zero odd level, 0 to 0.25%. Don't expect a hike right now, especially given the current economic situation. So yeah, that's something that we'll watch out for in terms of cues and what could perhaps guide our markets as well going forward, Varun.
Right, Mobina. Central bank week is what we should probably be calling it, because it's a low interest rate environment and we know that's going to stay steady. So now all we're going to look out for is there going to be more stimulus and what's the kind of demand outlook we're getting. But yes, definitely key drivers for our markets over the next week. Coming to what is moving within the market this morning, the BNSN stock cloud, quickly, let's just get that up for you. 10 new stocks that are featuring in there today. And we've been replenishing this list with different stocks every day, by the way. So the first one, Hexaware, we just mentioned, they have received some offers for the delisting process. So that's got that counter in focus. Then we have SpiceJet, one from the aviation name, which has recorded a 600 crore loss, much expected given all that's happened in Q1 for aviation. On the converse side, we have Vatek Vobag, which has actually posted some pretty stable numbers. Definitely some profitability improvement, although revenues were challenged. We have Aurobindo Pharma. Citi remains very optimistic on them, 1,020 rupee target. We have IndusInd Bank, CLSA, really stepping up the bank brokerage verdict. CLSA, SBI upgrade. Now we have an IndusInd upgrade as well. So that's also featuring in the cloud today. We have NMDC on the Doni Malai mines, which Mobina might talk more about later. Bharti Airtel and Sterlite, because Bharti is just finally performing a little bit after 2 days of, or rather a couple weeks of losing out. And then they've awarded Sterlite a massive fiber contract here in India to provide end-to-end integration for Bharti Airtel's fiber optics. So that's got those two counters in focus. Then we have an SBI, because the chairman and MD has said that the Yono digital app of SBI is more valuable than the bank. And we're going to be chatting with them later about that. And then finally, Jindal Stainless, also on the back of an Edelweiss upgrade to buy, featuring in the cloud today. So I believe now have our guests ready as always. Kunal Bothra and Gaurang Shah with us. Good morning. Great to have you both back on BNSN. Kunal, coming to you first. What are your high risk and low risk ideas today?
So good morning, Varun. I believe that the market texture looks to be quite okay. Yes, the Nifty and Bank Nifty are playing a bit of a dichotomous behavior. One is up, the other is down. But nevertheless, I believe that the overall sync, with both these indices is that the markets are, giving, more space towards those mid-cap, large-cap, stock-specific action to continue. So I think in that regards, I would expect that the market texture would remain and improve, and it would probably invite a lot of these other lagging or laggard kind of stocks to try and move up higher from current levels. So I would suggest two calls over here, two buy calls. The first would be from Bajaj, from the Bajaj a pack, and Bajaj Finance is what I would recommend as a buy. Now it's an interesting chart, and I for one believe that the stock is heading towards a very strong kind of a breakout on the short term, especially on the hourly time frame patterns. So, I think over the last, 1 month, particularly from mid of August, where the stock has finally managed to show some indicator breakout on the hourly time frame charts. And I believe that's a very important indicator for, Bajaj Finance. That generally leads into a strong recovery or a strong, comeback in prices for the stock price. That's what you've seen historically happening for the stock. And I believe, that given the kind of stature of the stock, if this moves up higher, then it adds a lot of stability and support to the overall market as well. So that's what I picked up as the first buy, recommending Bajaj Finance for a target of 3,700 approximately, and stop loss could be kept at 3,450 levels. The second would be a slightly high risk trade. It's a non-FNO stock, Century Textile, as the second opportunity or the second stock I would recommend to buy. Again, a very strong kind of a chart. It's been trading below its 200 moving average for, I think, the last 5-6 months. But then when you look at the chart patterns, it's now forming, like a cup and handle kind of a pattern, which is a bullish, price pattern on stock prices. And Century Textile is forming similar kind of a chart pattern. Because of the beta nature of the stock, because of the sharp movement which you typically see for Century Textile, I'll probably place it into a high risk category, and which is why I would recommend this as a buy as well. Slightly high risk trade, targets to be kept at almost 400 and stop loss at 355.
Okay, thanks for that, Kunal. So, high risk idea had a cup and handle formation. I feel like my technicals are also improving listening to Kunal every day. But Gaurang, let's come to you, getting a more fundamental view on things. But within that, of course, what's your high risk and low risk idea today?
Thank you, Varun, and morning to all of you also. Well, positive on the market with a little bit of consolidation at current levels, 11,450, 11,550, 600 could be the zone on the Nifty spot where you could see the market consolidate. But overall, remain positive. I wouldn't be surprised to once again see Nifty reclaiming 11,700, 800 over the next couple of days post this consolidation period. Having said that, I think we have a positive view on two sectors. Fundamentally, both of them are low risk, since these are low risk investment ideas fundamentally from a long-term time horizon. The first one is a company called Credit Access Grameen. Now, this is a classic play, Varun, of microfinance companies with large focus on semi-urban and rural India. Ticket sizes being relatively small, so their run rate in terms of repayment of principal and interest is relatively very, very comfortable. And if I have to reflect upon the earnings gone by, then this gives us a comfort sign that this company is well placed to the growth trajectory part. And over a longish period of time, we wouldn't be surprised to see levels of 850. These are all conservative side targets since this is a low risk stock. But if the earnings improve, we might revise the target upwards. The next one is from the IT pack, and this is one stock which has been consistently outperforming even the entire IT pack over the last 3 to 4 weeks, and I stand to be corrected if I'm wrong, is Tech Mahindra. We've been recommending this stock for a very long time. In the last three to 4 weeks, this was the time when the stock was having a consolidation period between 680 and 700. And then crossing over 700, we've seen a nice rally on Tech Mahindra. On the fallback of earnings, commentary from the management, and of course the outlook on the entire IT pack, we believe that this could be one of the outperforming stocks, targeting 920 from a longest time horizon. Again, a disclosure: if the earnings do not disappoint and if they excite us, then these targets also get revised upwards.
All right, there you have it. Those are the high risk and the low risk ideas coming in from Kunal and Gaurang. Well, this show, of course, also is dedicated to answering your questions and queries on stocks that you own, that perhaps you're interested in owning. So, let's get straight to that. And, don't forget, if you as well want your question to be answered, you can always write in to us on bnsn@etnow.tv. Let's take on board our first query. D.K. Thakur from Mumbai writes in saying that he bought 500 shares of IndusInd Bank at 550 rupees. He wants to know, should he stay invested or book out? Well, the fact that he's asking book out, I would assume that he's, recently bought the stock, after it had plummeted to 300 and then slowly started rising. He's in the money because the stock is currently at roughly about 650 rupees and he's bought 500 shares. So not bad. What would you recommend, Kunal, is the way forward for an IndusInd Bank? It's it's rebounded very well from the March lows, but it's still considerably lower than what it was pre-COVID.
Yeah, considerably lower than what was pre-COVID, and given the class of the bank historically as well, I think it's trading at a fair degree of discount, in relative terms, on pure price basis. But then when I look at the charts as well, I think the short-term charts are just about trying to get better for IndusInd Bank. Now the biggest overhang is when is that IndusInd Bank doesn't have an influence on Bank Nifty. So that's one very important observation to take note of. If it had been like the likes of ICICI Bank or Kotak Bank or HDFC Bank, the influence of these stocks on Bank Nifty is far more higher, of course, because of the higher weightage these stocks command. Now, IndusInd Bank on the chart patterns purely for me looks attractive because of the late August rally which we had seen when the stock had rallied from 525, 530 levels to almost a 700ish kind of a zone in a matter of some few trading sessions. Post that, it went to consolidation. Now these are typical signs which you generally see for a classic trend. So first wave of the rally is generally very swift and very quick. You generally see the prices moving up very fast, and then the second wave of the rally, which you see, is where the prices consolidate, and then it tries to gradually move up higher, converting the adventurous rally into more of a stable trend. I, for one, believe that IndusInd Bank is going through that second phase, where you would now see more of a maturity and more of stable price action from the stock prices. So if you're not in a hurry as such, since you've already bought at lower levels, then I believe you should hold on to your investments on IndusInd Bank, even if it's bought in the very very near term. And I believe, for one, that the stock has a very high probability of crossing that 700, 725 zone as well, which it tested in the month of August.
Right. Well, that's the view on IndusInd Bank. Gaurang, let's just get a bit more of a fundamental view from you. The fact that, like I mentioned, IndusInd Bank is really far away from what it was pre-COVID. Do you think this gives an opportunity for people to lap up some of the shares, or would this be, a pick that you would recommend from the private banking space, or for now maybe there are more fish in the sea?
So, Mubina, well, first of all, we have a buy coverage on the fundamental side. And yes, the stock was trading at 1200, 1300 odd before the negative news on the loan book, gross and net NPA provisioning came in the public domain, and as disclosed by the management during their various quarterly numbers. From those levels, correct me if I'm wrong, we saw close to 350, 300 low on IndusInd Bank. And now with the situation turning for good, first of all, I think your investment in IndusInd Bank will test your patience. It has already done that, and it may possibly do it further for a maybe quarter or two, unless we have absolute clarity on the balance sheet, gross and net NPA, and of course the recovery path. So we remain positive with a long-term bias. And for this investor, well, if you have time by your side, you can stay invested. There will be bouts of profit booking because a lot of investors have got stuck into this stock for a very long period of time due to underperformance and fallback of earnings negativity. But that seems to be a thing of the past, if I have to reflect upon the recent numbers and the commentary from the management. So if you have invested, stay invested, use dips to add to the stock. I would not be surprised to see the lost glory coming back into the stock, subject to provided you have a longish time horizon. And if you have not got invested in private sector bank, if you're looking for getting invested, then your priorities should be different. I'm not saying that you should not invest in IndusInd Bank. The only caveat is that this investment in IndusInd Bank will come with a little bit of risk. And if you want to have a little bit of risk averse kind of an investment idea, then preferred ideas would be HDFC Bank, Axis Bank, ICICI Bank, and Kotak Mahindra Bank.
Okay, Gaurang, read you loud and clear there. Stick with the larger private guys. IndusInd might implore a greater degree of risk. But switching gears and then coming perhaps to an even more riskier stock given the run-up we've seen in it lately, IndiaMart. And we have Harsh Patel from Jaipur writing to us. He's bought 200 shares of IndiaMart at 4,400. So very recently, although it has just been surging, it's about 10% away from where it currently stands. Should I book out or hold? So Kunal, what do you think? Do you think IndiaMart's ripe for a correction given the run-up we've seen and one can possibly re-enter sub 4,000 or at 4,000? Or do you think that you should just stay invested right now?
So I think the short-term charts indicate that the stock is going through more of a exhaustion phase, more of an overbought nature. I think that's a much better word than for IndiaMart specifically. And I believe that the reason why I believe that it's gone to an overbought nature is because of the sudden move. So in July, I think June end or July start, the stock was at 2,000 levels or sub 2,000 levels. In a matter of 1.5 odd month, you saw the stock moving up almost 2.5 odd x, 2.5 odd times from those sub 2,000 levels. Now it's natural that when you see a sudden rise into the stock prices in a short-term kind of a time frame, the indicators they tend to get into an overbought zone. There is price consolidation which happens. There is a natural whipsaw volatility phase which happens for such kind of stocks. So I for one believe that I think if you bought at recent levels of 4,400 and the stock is at approximately 5,000 levels, I think you're sitting at a 10% approximately profit on your investments over here. You should look to book out and use opportunities of sharp periods of corrections to try and buy these stocks. Now, indicators on the daily time frame, on the hourly time frame are at an extremely overbought level. And when you generally see an extremely overbought level, two things typically happen. One is either the prices go through a prolonged consolidation. So if you've seen 2 months of rally, it could be possible that the stock may not do much for the next 1 or 2 months, remain more sideways, or else you will see a sharper correction to the stock price. Now, in whichever format you see the stock prices behave, there is a strong possibility that the stock may come back to say 4,400 or fall below that as well if there is a corrective phase which happens into the stock price. So I for one believe you should look out to book your profits somewhere closer to this 5,000-ish level for India Mart, and then look to buy back again as and how the stock goes through a sharper period of correction.
Kunal likes it, but he wants the price to be a little lower before you'd get in. Gaurang, how do you view this stock fundamentally? I mean, price to earnings.
Reflection of the ravages of COVID-19. Nevertheless, high-frequency indicators of agricultural activity, the Purchasing Managers Index, that is PMI for manufacturing, and certain private estimates for unemployment point to some stabilization of economic activity in the second quarter of the current year. While, of course, contractions in several other sectors are also simultaneously easing. The recovery is, however, not yet fully entrenched, and moreover, in some sectors, the uptick which was noticed in June and July, they appear to have leveled off. By all indications, the recovery is likely to be gradual as efforts towards the reopening of the economy are confronted with rising infections. The global economy is estimated to have suffered the sharpest contraction in living memory in April to June 2020 on a seasonally adjusted quarter-on-quarter basis. World merchandise trade is estimated to have registered a steep year-on-year decline of more than 18% in the second quarter of 2020 calendar year. And this is the estimate of the WTO. High-frequency indicators point to a trough in global economic activity in April to June quarter, and a subsequent recovery is underway in several economies such as USA, UK, Euro area, and Russia. The global manufacturing index and services PMIs rose to 51.8 and 51.9 respectively in August from 50.6, which is 50.6 for both in July. Yet infections remain stubbornly high in the Americas and are increasing again in many European and Asian countries, causing some of them to renew containment measures. On the back of large policy stimulus and indications of somewhat hesitant economic recovery, global financial markets have, however, turned a bit. Equity markets in both advanced and emerging market economies have bounced back, scaling new peaks after COVID crash in February and March. Bond yields have also hardened, and I'm referring to advanced economies now. Bond yields have also hardened in advanced economies on improvement in risk appetite, fueling shift in investors' preferences towards riskier assets. Portfolio flows to EMEs have also resumed, and this has pushed up EME currencies, aided also by US dollars weakness following the Fed's recent communication on pursuing an average inflation targeting. Gold prices moderated after reaching an all-time high in the first week of August 2020 on prospects of economic recovery. Financial market conditions in India have significantly eased across segments in response to front-loaded cut in policy repo rate by the RBI and the large system-wide as well as targeted infusion of liquidity, which you have referred to in your opening remarks. Now, despite substantial increase in the borrowing program of the government, and I'm now sort of, you can see that I had anticipated some of the points which you have made. So I just try to touch upon it as a part of my opening remarks. So, despite substantial increase in the borrowing program of the government, you can see that the persistently large surplus liquidity conditions which the Reserve Bank has ensured has facilitated non-disruptive mobilization of resources at the lowest borrowing costs in a decade. In fact, I was looking at the GSEC rates, and the current GSEC borrowing rates are perhaps the lowest in the last 10 years. And this is mainly because of the kind of liquidity which we have provided to the market. In August 2020, the yield on 10-year GSEC benchmark surged by 35 basis points amidst concerns over inflation and further increase in supply of government papers. Following RBI's announcement of special open market operations, which you referred to as Operation Twist, and other measures to restore orderly functioning of the GSEC market, bond yields have softened and traded in a narrow range in September. Although bank credit growth remains muted, scheduled commercial banks' investments in commercial paper, bonds, debentures, and shares of corporate bodies in the year so far, that is up to August, from April to August, they have increased by, please note the numbers, current year, the bank investment in all these debentures, commercial papers, etc., in the current year up to August 28th, they have increased by 5,615 crores as against a decline of about 32,000 crore during the same period last year. Moreover, the benign financing conditions and the substantial narrowing of spreads have spurred a record issuance of corporate bonds of close to rupees 3,20,000 crores during 2021 up to August. And here I would like to refer, there was a mention, you made a mention about that liquidity is not available to NBFCs and NBFCs. May I sort of submit for your consideration that the liquidity line which we opened for all India financial institutions like NABARD, the SIDBI, and the National Housing Bank, now that has actually flowed to cooperative banks. It has flowed to mutual fund. It has moved to microfinance institutions, and some of it has also flowed to small NBFCs. So therefore, we have not, we have taken care of that particular segment of MFIs, smaller size NBFCs, and the cooperative banks. In fact, NABARD, even in the last announcement in August, we announced another 10,000 crore for NABARD. So we are constantly, and through SIDBI also, a lot of capital, lot of liquidity, liquidity has moved to various MSME and MFIs also. So, and we are in constant engagement with all these all India financial institutions like NABARD, SIDBI, and the National Housing Bank. And we are also very carefully monitoring the markets, and as and when required, further measures will be taken. I have said it earlier during my various statements that the RBI stands fully prepared. In fact, I had used the terminology that the RBI stands battle ready, and whatever measures are required will be taken up by the RBI. And here I must also like to take this opportunity to compliment and thank my colleagues in RBI who have been working day in and day out in supporting me and in facilitating many of these decisions, timely and proactive decisions. Now, the immediate policy response to COVID in India has been to prioritize the stabilization of the economy and support a quick recovery. Policies for durable and sustainable high growth in the medium term after the crisis, nevertheless, are quite important. And in my address today, I propose to dwell upon that issue squarely. What could potentially lift up India's economy to trend growth as the recovery begins? While interacting with members of the CII on July 27th, I had covered 5 major dynamic shifts taking place in the Indian economy. Number one, fortunes shifting in favor of the farm sector. Number 2, changing energy mix in favor of renewables. 3, leveraging information technology, ICT, and startups to power growth. 4, shifts in supply or value chains, both domestic and global. And 5, infrastructure as the force multiplier for growth. Today, I would like to touch upon 5 different areas that I feel would determine our ability to step up and sustain India's growth in the medium term. Number 1, human capital, in particular education and health. Number 2, productivity. 3, exports, which is linked to raising India's role in the global value chain. 4, tourism. 5, food processing and associated productivity gains. Let me first touch upon human capital, the importance of, and with specific reference to the importance of education and health, and the need to take certain measures in these 2 areas. Now, investing in people adds to the stock of skills, expertise, and knowledge available in the country. The assignment of importance to education dates back to Plato, Aristotle, Socrates, and Kautilya. Its significance for economic development has received progressively increased attention in recent decades, especially in the work of several Nobel laureates, including T.W. Schultz, Gary Becker, Robert Lucas, and James Heckman. There has come about an explicit recognition of education as human capital in endogenous growth theory, backed up by cross-country empirical evidence. In India, states with higher literacy rates are found to have higher per capita income, lesser infant mortality, better health conditions, and also lower poverty. Education and skill development, however, contribute less than half a percentage point to our overall labor productivity growth. In order to reap the demographic dividend, we have to raise expenditure on education and acquisition of skills substantially. It is important to recognize that investment in education pays by raising average wages. In Global Education Monitoring Report of 2012, the UNESCO highlighted that every $1, that is every $1 spent on education, generates additional income of about $15. A World Bank report of 2014 showed that an additional year of schooling increases earnings by 10% a year. Higher education contributes to economic development through greater sensitivity to environment and climate change, energy use, civic participation, and healthy lifestyle. The new education policy, a historic and much needed new age reform, has the potential to leverage India's favorable demographics by prioritizing human capital. The goal to increase public investment in education sector to 6% of GDP must be pursued rigorously. And here, I think there is an important role for a public-private partnership also, which I would believe, and which I would like to sincerely believe, and which has been proved through empirical evidence, that education facilities created through public-private partnerships can, sort of generate quality education, can impart quality education at affordable costs while maintaining the financial viability of private investment. Indian banks and financial system would need to respond proactively to opportunities arising from the new education policy for new financing. Besides improving access to education, focus on quality of education is also very important. And, I have a prepared text of my speech. I'm not reading out the entire speech. It will be uploaded in the RBI website immediately after this session is over. So anyone interested can please have a look at the speech will be uploaded, but I will just touch upon some of the points and then conclude and leave sufficient time for discussion. Health, similarly, is another vital component of human capital, and good health increases life expectancy and productive working years. In high-income countries, the per capita health expenditure is naturally very high compared to countries like emerging economies like India. I have the figures here. I'm just skipping that. Now, COVID has brought to the fore the importance of easy access to health services to contain mortality rate given significant interstate and intrastate differences in health care infrastructure. And while laudable crisis time response to scale up health infrastructure has helped in dealing with the health emergency, I'm referring to India, a more comprehensive approach similar to the new education policy for health sector may also be warranted, which must also cover deeper penetration of insurance and also preventive care. Greater attention is required to improve the healthcare ecosystem by ensuring creation of new medical colleges, higher education, research institutes in the area of medical science, higher number of postgraduate seats, and setting up new colleges for paramedics and nursing. Let me now touch upon the second point, which deals with productivity growth. Now, by any reckoning, COVID-19 will leave long-lasting scars on the productivity levels of countries around the world. According to a very recent World Bank assessment, which was done in 2020 in the context of the pandemic, COVID-19 could entail adverse effects on productivity because of dislocation of labor, disruption of value chains, and decline in innovations. During earlier episodes of epidemics in the past, like the SARS, the MERS, the Ebola, and Zika, productivity is estimated to have declined by 4% over 3 years. The COVID impact on productivity could be expected to be much larger. And this is a worldwide survey which the World Bank assessment which the World Bank has undertaken. Now, CLEMS, which stands for Capital, Labor, Energy, Materials, and Services, a database hosted by the Reserve Bank, shows that India's economy experienced an overall productivity growth of 0.9% per annum on an average over a period 1980-81 to 2017-18. In the immediate post-global financial crisis period, that is from 2008-9 to 12-13, there was, however, a decline in productivity by 0.3% annually, while the period thereafter, up to 2017-18, recorded annual productivity growth of 2.4%. The contribution of productivity growth to overall GDP growth of the Indian economy over the period 80-81 to 2017-18 was about 15%. More recently, during 2013-14 to 17-18, its contribution, that is contribution of productivity, increased significantly to about 34%. The share of patents applied and granted to India in the total patents granted globally has been rising over the years, and this is another area, I think, which also requires attention. Stepping up R&D investment in other areas would require more efforts by the private sector, with the government focusing on creating an enabling environment. You see, most of the advanced economies and other countries, a lot of investment in R&D takes place by the private sector. In India, so far, it has been primarily public sector driven. There is investment. I mean, there are efforts being undertaken by the private sector, no denying. But this is, I think, one area where there are opportunities for the private sector. And I would like to utilize this opportunity to sort of appeal and to sort of mention to you for your consideration that I think private sector also needs to focus on research and development. Now, the innovation hub you have mentioned, Reserve Bank has launched it. We are not going into it. The India Innovation Index released by the Niti Aayog last year has been widely accepted, and I think that can act as a platform for more emphasis and more focus on innovation. The third point I wanted to touch upon is with regard to global value chains. Now, the impediments to global value chains have been identified in the post GFC, that is the post-global financial crisis, and they are more, I'm talking about the global scenario. Globally, the key impediments to exports after the GFC, global financial crisis, they include generalized increase in protectionism by trading partners, weak global conditions. Then you have automation and several other factors coming in. Notwithstanding these impediments and also the significant decline in trade intensity of world GDP growth in the post-GFC period, opportunities for expanding exports arising from vastly altered global landscape for trade, where more than two-thirds of world trade occurs through global value chains. Now, this is very important. Two-thirds of the world trade occurs through global value chains. And today, India, we are on the threshold of a big opportunity to break into the global value chain. And I think this is one area where government, all authorities concerned, and more particularly private sector, private industry, private business need to work together. It is an opportunity available for Indian business to try and to enter into the new opportunities, to capitalize the new opportunities which the current crisis has opened up, for new players to to become a part of the global value chain. India's participation in the global value chain is quite low and it can be improved. I'm not going into that any further. Now, among the sunrise sectors that offer potential for higher exports in the post-COVID period are, of course, obviously drugs and pharmaceuticals. And it's very heartening to note that many of our Indian companies are, they have sort of become global suppliers of various kinds of medicines and drugs. And this is an area where India has certain competitive advantages and that needs to be capitalized. A sharp policy focus on other global value chain intensive network products, including equipment for IT hardware, electronic appliances, electronics and telecommunications and automobiles would also provide the cutting edge to India's export strategy with considerable scope for higher value additions. Domestic policies need to focus on right mix of local and foreign content in exports while aiming to enhance participation in GVCs. It is also important to learn from global experience and nurture those trade agreements that go beyond traditional market access issues. Provisions relating to investment, competition, intellectual property rights, protection have a larger positive impact on global value chains, GVC trade, and need to be assiduously cultivated and integrated into the Indian ecosystem. Now, so therefore, I have touched upon three of these aspects. The other, other two aspects which I have listed out are tourism as an engine for growth. Now, tourism has been one of the sectors in the economy most severely impacted by COVID-19. At the same time, this is also a sector where pent-up demand could drive a V-shaped recovery when the situation normalizes. India, as you know, has tremendous potential in tourism, and the challenge, nevertheless, is to scale up our tourism market and enhance its contribution to economic development. The employment elasticity of tourism sector is very high, and it needs to be capitalized. I'm happy to note that a multi-pronged approach, a policy approach, has been taken up by the government, and this is one area where, again, the private sector has an important role. The fifth and the last point which I would like to mention, and the details are there in the speech, so you could perhaps have a look at it, and others also who are part of this webinar may please have a look at it in the RBI website, because I have given a lot of points and a lot of data and other things which may be of interest. Now, food processing food processing for surplus management is also very, very important. And this is, so far as India is concerned, this is in fact a sunrise industry. Globally, its importance in consumer basket has increased over time, led by rising per capita incomes, urbanization, and change in consumer perceptions regarding quality and safety. Despite being one of the largest producers of several agricultural commodities in the world, India ranks fairly low in the global food processing value chain. There is therefore a need to move up in the value chain. And India can certainly move up in the global agricultural value chain by increasing its share of processed food exports, for which quality standards will be critical factor. This is again an area which I would like to submit for your consideration and consideration of your members and others. That this is one area where I think Indian business and private sector can focus on and should make an effort to again make their presence felt in the global value chain. In my address today, let me now conclude. In my address today, I have highlighted 5 critical areas that can determine the shape of our post-COVID trend growth. Now, I have highlighted these 5 areas, and these 5 areas should be read in conjunction with the 5 areas which I had earlier mentioned to the other apex industry body, the CII. So there are totally 10 points which I have highlighted, and I would like to believe that these are the areas where there are opportunities for private sector, and these opportunities need to be capitalized. I have highlighted 5 critical areas, as I have said, which can determine the shape of our post-COVID trend growth. While dealing with immediate crisis management challenges, we need to strategically prepare for our combined overriding goal, the pursuit of strong and sustainable growth. The private business sector has a critical role in each of the 5 areas I covered today. The enabling policy environment would evolve around the initiatives taken by India's businesses to seize these opportunities and actualize the potential of Indian economy as a rising economic power of the 21st century. COVID-19 has changed our lives, and it is increasingly clear that life will never be the same again. We should look upon these fundamental changes as opportunities rather than threats, converting them into game-changing new vistas of progress. I do sincerely believe that together as a nation, we can certainly do this and achieve our objectives. Let me conclude on this optimistic note. Thank you.
So thank you very much. Comprehensive, optimistic, and definitely what we were looking to hear. Since time is short, we'll jump directly into the questions, sir. But we have noted all your points. We'll go to the website, take the speech, and also add it into our website and disseminate it to our members. So may I make the first comment that I appreciate the inclusion of health into one of your focus and priority areas, being from that sector myself, and request for an inclusion into the guidelines. The Kamath committee did not specifically call out health, would request for that special focus on that one, especially because small nursing homes, etc., have had significant.
You just heard out the RBI Governor Shaktikanta Das just speaking at the FICCI event, talking, of course, about the state of the affairs currently, and he does believe that recovery will be gradual because COVID infections are still very high in some countries, which could cause countries to go under lockdown again. But at the same time, investors in advanced economies are still fleeing to riskier assets, and bond yields are hardening in advanced economies. Okay, well, we'll do one thing. We'll take a very short break right here on the show. Don't go anywhere.
Welcome back to Buy Now, Sell Now. Launching a brand new segment on BNSN today, BNSN Explained. We take complex investing concepts and terminologies and simplify so that you too can improve your understanding and get in on the action. Today's topic is about cash flow. Many a time, businesses show huge growth and increase in profits, but behind the scenes is a grim cash flow situation. We, in this first episode of BNSN Explainers, help you understand whether your investment is really generating cash or simply inflating the numbers. We all have that healthy friend who takes a million selfies at the gym. However, when he or she goes home, it's a very different story. The same way in markets, how can we tell that the companies we invest in aren't just painting a rosy picture? How do we know that they aren't inflating the numbers and are making real cash profits? We at ET Now are about to help you find out. Cash flow can be a very difficult concept to wrap your head around. It's often confused with profits, and there are some complex terminologies which can be misleading. However, today we're going to simplify via 3 simple examples. Example 1. You're a seller selling 1 crore worth of merchandise. This merchandise which you're selling cost you 80 lakhs. Hence, when you sell it to the buyer for 1 crore, you make a 20 lakh profit, and your cash flow is equal to 1 crore minus the 80 lakhs which it cost you, which is also equal to 20 lakhs. Example 2. Again, you're selling the same merchandise at the same price of 1 crore. It also cost you the same amount to buy, 80 lakhs. So once again, your profit on the sale is going to be 20 lakhs. However, this time, due to cash constraints, your customer is only able to pay you 70 lakhs upfront, and he requests you to give him 30 lakhs credit. So this time, your net cash flow will be the 80 lakhs that you spent minus the 70 lakhs that you received, meaning you actually have a negative 10 lakh cash flow until you collect the balance funds. So in this case, your profit is the same, but your cash flow is actually negative 10 lakhs. On the opposite end of this, in the third example, you have a situation where you are again selling 1 crore worth of merchandise, which costs you 80 lakhs to procure. So like example 1 and 2, again, your profit here is going to be 20 lakhs. However, this time, your customer, feeling generous, pays you 1.1 crore with 10 lakhs as an advance for a future order. So in this case, your profit is the same 20 lakh, but your net cash flow increases by 10 lakh to 30 lakh. So that's how you evaluate cash flow transactions. Each transaction will give you the same profit figure, but it will never give you the same cash flow figure. And a positive cash flow, like you can see in example 3 or in example 1, are what you're looking for. What you're definitely not looking for is a negative cash flow, which you see in example 2.
All right, well, I guess the concept of cash flows, and I hope it's been cleared in a lot of your minds. And if you've liked this package, well, stay tuned to Buy Now, Sell Now. We'll keep getting you more of such tidbits. With that, we'll wrap it up on the show.